So we talked about different sorts of lending sources, right? Like we throw out these words: agency, CMBS, local banks. Can we talk about like what the pros and cons are to some of that? I mean, I know for us, we've done an agency debt deal and didn't have a great experience. Now we've slowly worked with local banks. So just so people get a better idea of like what those are and the pros and cons of those.
Okay, so agency is defined as like Fannie, Freddie, HUD, commercial mortgage-backed securities. Basically, these are non-recourse or non-personally guaranteed loans. Well, they have something called bad boy carve-outs, which is a term that means, hey, you don't have to sign on the dotted line, but if we find out that you defrauded us, we're coming after you. So in theory, anybody could sue somebody for anything as long as they get a judge to bite off on it. But like what Scott talked about earlier this morning, like a HUD deal, those advantages are you could do a 35-year fix with no personal guarantee, or if you do the construction with HUD, you can get a 40-year fix with no personal guarantee. The other advantages to agency debt are usually a lower debt service coverage requirement. I think HUD's at like 117 or 118 for multifamily today, and they also do like senior housing, assisted living, things like that. So they won't work with every single asset class, and especially if there's like different services within there, like memory care, and we can go on and on forever. Commercial mortgage-backed securities are usually designed for multi-tenant buildings like retail, office, mixed use, quirky type stuff, generally like, 1.4 debt service coverage or something like that. So the advantages are non-recourse and they're assumable loans. So an assumable loan means that if you're gonna buy the property from somebody, you can assume their debt as well, which can be good if it's in the beginning of the life cycle of the loan. The advantages to bank loans is you have a relationship. I wanna add to something that Matt said earlier about community banking. The one caveat I'll add is that see if you can find out if your community bank president or CEO, if they have real estate experience personally. Because guys like Ed or Doug Gordon at Waterstone or other guys, they get real estate. Sometimes you can't find this answer out. But I work with community banks that they don't look at it that way. You have to do some serious digging on them as much as they do on you. So while a community bank can be an advantage for a quick decision, if you get somebody who doesn't like real estate, that could be a huge disadvantage. I would say the banks are easier to work with generally. Like agency debt's very expensive, it's very time consuming, it's securitized, it's tedious, a lot of legal fees, a lot of inspection fees. So be patient with them, but the long-term benefits are huge.
Yeah, on HUD specifically, I've seen so many friends and clients go down that path because they're allured by the, oh my God, look how long this loan is, this amortization is 40 years, my rate is 2.9% and it's non-recourse, how amazing. I said, okay, buddy, go ahead and do your thing. 6 months later, they call and hey, this has been the biggest headache ever, and by the way, I'm out 250 grand in application fees, I just can't do it. I mean, I've never seen a HUD fee less than 250 grand. So if you're gonna do that, it is the best product out there for multifamily, but you have to have the stomach to stomach the fees and the headaches that's gonna come along with the process of getting accepted and it's about a year-long process usually. They say it's 6 months, it's never 6 months. Freddie, Fannie, I like them. Little more flexibility than some others, but it's non-recourse, but also, I mean, when they say it's assumable if the guy you're selling your property to is stronger than you. If he's not, I've not seen him approve an assumption. The CMBS stuff, I feel like it's just a matter of, I think what Scott said this morning was your risk profile. If you really want non-recourse, that's the way to go. It's the only way to go. Usually on those property types, it's retail and office, commercial. But the issue you have there is inflexibility. Let's say you have a tenant leave your strip center and you need to put some TIs to get a new tenant in there. Well, that's good news money, as we call it, right? But that's not how they see it. They don't want anything changing. They just want to get their monthly payment. So you're going to have to make a large prepayment penalty, most likely, to take them out, go to a bank, get them to give you a loan for the TIs, and then lease it back up, and then pay another fee to go to the CMBS market again, or the life company market. So again, it's just your risk profile. The greatest thing is it's non-recourse. So all those guys that didn't have a big appetite for risk, well, I guess you have to do office. But if they didn't want to sign the recourse, they went to the CMBS market, and now they're going to lose all their equity, but at least they're going to walk away without having to file bankruptcy because they're going to get sued on their guarantee. So I think Rickey and I both would agree that bank financing is the way to go. But again, if personal recourse keeps you up at night, no one wants to be up at night, so then that agency debt is the way to go.